During the underwriting process, the underwriter uses two ratios to help determine if a borrower will qualify for a loan. These two ratios are known as the housing expense ratio and the debt-to-income ratio. The housing expense ratio is also referred to as the front-end ratio, while the debt-to-income ratio is also known as the back-end ratio. For the purposes of this lesson, we will use the ratios set forth by the FHA. However, every lender may use slightly different qualifying ratios. The housing expense ratio. The FHA currently sets the housing expense ratio at 31%. This only takes into account housing-related expenses, such as monthly mortgage payments, property taxes, insurance, etc. The formula for the housing expense ratio equals the following: total monthly housing expenses divided by total monthly income. What this ratio means is a borrower's total monthly housing expenses cannot exceed 31% of their gross monthly income. Let's take a look at an example to illustrate how this ratio is used. Amy is looking to obtain a $265,000 loan to purchase a $410,000 house. Amy's monthly housing expenses amount to the following: mortgage payment, $1,304, property taxes, $380, insurance, $95. Will Amy qualify for the loan if her monthly income equals $5,800? To answer this question, we first have to add up the total housing costs. These equal $1,304 plus $380 plus $95 equals $1,779. Next, we have to divide this number into Amy's monthly gross income. $1,779 divided by $5,800 equals 0.3067, or just under 31%. In this example, Amy would qualify on the front-end ratio because her housing expenses do not exceed 31% of her monthly income. Next, Amy will also have to qualify using the back-end ratio. Debt-to-income ratio. The FHA currently sets the debt-to-income ratio at 43%. The debt-to-income ratio takes into account all of the borrower's monthly recurring financial obligations in relation to their monthly income. In other words, what other loans is the borrower responsible for? These include all housing expenses from the front-end ratio, plus any outstanding student loans, car loans, credit cards, phone loan, etc. All of the borrower's recurring monthly obligations cannot exceed 43% of their monthly income. Let's continue with the previous example to see if Amy will qualify on the back-end ratio. Amy's monthly housing expenses total $1,779. In addition, Amy has the following monthly loan bills: student loans, $350, car loan, $410, credit cards, $90, smartphone, $45. These debt obligations add up to $895. When we add Amy's housing expenses to her other debt obligations, we get a total of $2,674, $1,779 plus $895. Finally, we have to divide $2,674 into her gross monthly income of $5,800. $2,674 divided by $5,800 equals 0.461, or 46%. Since Amy's back-end ratio exceeds 43%, she will not qualify for the loan. In order to qualify, she will have to pay off some of her existing debt to lower her monthly debt obligations. For example, if Amy were to pay off her student loans, her back-end ratio would drop to 40%, and thus allow her to qualify for the new mortgage.